All right. In today's episode of the Morales Group Show, we're going to be interviewing Guillermo Serafin with Serve First Realty. We're going to be talking about how to get a loan modification approved. We're going to be talking about what is a loan modification, who qualifies for a loan modification, how does a loan modification process work, what documents do you need for a loan modification, how long does a loan modification typically take? We're going to be talking about credit score, and we're also going to be giving you tips and tricks to be able to get your loan modification approved. Welcome to the show, Guillermo. How are you?
I'm doing well, man. Thank you for having me.
Of course. So let's just jump right into it. So what is a loan modification, and how does that differ from like a refinance?
So a loan modification is usually offered to people when they fall behind on their payments. It's rarely something that's offered just out of nowhere, out of the blue, just to make your payment better. However, with what happened in the pandemic, they were offering loan modifications to people who were currently current. So that was a once in a lifetime kind of situation. And all those programs kind of already ran their course. But the difference between a loan modification and a refinance is something that you do because you want to lower your rate or pull some money out, and you're going to go hire a loan broker or a lender or somebody to help you with it because you have to qualify for it. You have to have great credit and things of that nature. A loan modification is actually the opposite. The loan modification is for people who don't have great credit because they've been falling behind on their mortgage and they're in a tight bind. And that's pretty much the biggest, I guess, obvious difference, if you would say.
Is it required to be behind on your mortgage payment in order to get the loan modification process going? Or is it basically, can you get a loan modification without being behind on the mortgage payment?
It's all going to depend on the servicer, but the unsaid kind of thing is usually you have better chances if you're behind. Now, that doesn't mean fall behind on your mortgage because it doesn't guarantee that you're going to get approved for one. But, it's just like back in the day during the 2008 crash, people would say, like, hey, you can do a short sale even if you're not behind on payments. Technically, you could. I personally, after doing hundreds of short sales and loan modifications, never saw one get approved on somebody who was current.
Got it. So basically, like, and I've heard this from clients, and obviously we're not suggesting for anybody to get behind on the payments, but I've heard clients reach out to the banks telling them that they need a loan modification. And it's almost like because they're not behind on the payments, they go like on the back burner, and the priority clients are the ones that are delinquent in one way or another. And in cases, I've even heard the servicers tell them like, hey, look, like, unfortunately, like, unless you're behind, which is a catch-22 because nobody wants to get behind on their payments,
Yeah, exactly. And the thing is, you got to look at it from the servicer and the investor's side, right? Because every loan has investors on the secondary market, and you have to think if somebody's making their payments with on time, why would they want to reduce the amount of money that they're collecting from them?
Doesn't make any sense. So on a loan modification, how is that typically structured? Is it like, in order to be able to reduce the payment, do they lower the interest rate? Do they do a principal like add a balloon payment to the end if you're behind on payments? Do they extend the term of the rate? Instead of making it a 30-year, they make it a 40? What do you typically see there?
So it really depends on the servicer and the program that they offer you, because I've seen them all from a combination of they make a 30-year or 40-year and then they drop the interest rate as well. So that obviously makes it a lot more affordable. I've seen where somebody fell behind and they've got like $30,000 in arrears, and they take that money and they put it on the back of the loan and then start them over with restart their loan with a lower interest rate. Um, it just depends because it's really up to them how they want to do it. The biggest thing is that they want to turn that loan back into a performing asset. So if they can figure out a way to do that, it benefits them and the borrower.
Got it. And then you said during COVID, you actually saw it where they were modifying people's loans without them getting behind. What did you mean by that?
So, and during COVID, I've seen, people they went in and they were offered a loan modification, if they had an FHA loan or whatever, and they just went on the online portal and they had to click like, what would you like? Would you like, this or that? And they just clicked and the loan was automatically modified, which was definitely not the experience that we had to go through during the 2008 crash. We had to fight for those, and most loan modifications you really have to be diligent and fight for.
Got it. What is typically required to start the loan modification process? Like, obviously, like if you're behind, we don't want to get into that, but like what type of documents are required? How long does the process usually take, etc.?
So the process can take anywhere from 30 days to months. It just depends on the servicer, depends on how quickly you get them their paperwork, how quickly you are about making sure they get their paperwork. Don't assume that because you sent it in that they got it. Most of the time it gets lost. And if you send in a complete package or you send in a partial package, all those things make a huge difference. Um, the 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 best thing that I can say is that to get started, every lender has their own package. Like, I don't know if you remember back when they had the Making Homes Affordable, the HAMP program. So
Yeah.
that was kind of a generic package that everybody had to fill out. Well, that program obviously expired, and now every lender has their own kind of servicing package. In California, we have what's called the Homeowner Bill of Rights, which makes lenders do certain steps before they can actually foreclose. They have to, offer assistance. They have to contact so many times and things of that nature. So you just have to make sure that the first thing you do is you reach out to your lender or a HUD counselor or a realtor or broker who understands loan modifications so that you can get some guidance on doing it, because communication is key. And that's what's going to make or break if you are able to get one or not.
So would you say that the first step is reaching out to your servicer and asking them for a loan modification package? Because every servicer is going to have a different package to see what that package would look like and for you to start collecting information from them?
Yeah, the first thing is you reach out and you say, "Hey, I'm behind on my mortgage and I'd like to know my options about applying for a loan modification or getting some kind of assistance." And they'll tell you where to go. Everything from, like, if you're going to have a third party help you, like your broker, your local broker or a HUD or whatever, there's going to need to be a third party authorization signed, and all of those are even different. Some require to be notarized, some don't. So you really want to make sure that you're using lender specific documents. I know there's a lot of people out there that'll say, "Hey, here's your package, use this, send this to your bank." And sometimes that just kind of delays things and screws things up. So your best bet is always get the paperwork directly from your lender when you need it, the most recent, because they always change their forms, and it's always best to work with that.
And then probably asking them, like, I know for short sales, and a lot of people don't know this, that some of the servicers require wet signatures versus a digital signature, basically. So, like, if you get that package, asking them up front, like, hey, look, are any of these documents required to be notarized? Do any of these documents require for it to be a wet signature versus like a digital signature? That way, whenever you submit that package, like, it increases the chances of you submitting it the right way versus submitting it incorrectly. Like, I know that was one of the changes that we made to our short sale packages. What's typically included in these loan modification packages for different servicers? Like, what do they typically want to see? Like bank statements, proof of funds.
So yeah,
What are they wanting to see?
usually they want to see pay stubs. That's the biggest thing, is pay stubs, recent pay stubs, right? Where you're going to get, what's your ability to pay, where are you making your money from, how much are you making. They want to see a list of your bills. They want to see bank statements, and and they want to see a hardship letter sometimes. And those are the basics to get you started. One of the things that I would, one of the tips is, don't submit anything unless it's a complete package. And the reason that I say that, and this is, I verified this with loss mitigation officers of all the big banks. When you submit an incomplete file, it goes into a separate pile, and that's the pile that they work on after they work on the files that are already completed. That means that those are the files that don't get the most love, that the irritated people have to deal with. So this whole process, you want to keep the bank as happy and on your side as much as possible.
Got it. Okay. And then here's the magical question. Like, what are the banks looking for? Like, so this is a rumor that I heard, and I don't know if this is true, but back in 2007, 8, 9, 10, I would get complaints from clients be like, oh, my loan modification got rejected. And the very common thing that I would hear was they say I make too much money or they say I make too little money. So it was almost like there was some sort of magical formula like you can't make too much money because then they may be like, well, based on the income that you make, it shows that you have the ability to make your payment. Like, why would I give you a loan modification if you have enough income? And then if you don't make enough income, they're like, well, we aren't going to give you a loan modification because you don't make enough income. Like, how does that typically work?
So there is no standard guideline because every servicer is different. But what I can tell you as a rule of thumb is if you look at it as like if you were underwriting a borrower for a mortgage, right? So if you're looking at trying to do, let's just use easy numbers. If you need your mortgage adjusted to $2,000 a month, that $2,000 should be about 45%, no, to 50% at max of your income. So if you need a $2,000 payment, you need to be making $4,000 a month, right? Um, and if you can kind of keep in those numbers, those are usually pretty safe. If you're making, if you're making $8,000 and you're telling them that you need to reduce your payment to 2,000, they're probably going to, kick it back because they're going to go, what the heck are you doing with the other $6,000?
Yeah, exactly. Yeah. And then the other thing is, do lenders take monthly obligations into consideration? Like, so let's say that you are making, let's say for simplicity purposes, $10,000 a month. But let's say that you have a car payment that's 1,000. Let's say you have two car payments at 1,000. That's $2,000. And let's say for whatever reason you have credit cards at $1,000 a month. So your gross income after the car payments and credit cards is like $7,000. Do they take the debts into consideration or no?
They do take the debts into consideration. How much consideration, they give it is completely up to, the lender and the servicer, but they will take you because they will ask you what's your monthly bills. They want to know utilities that, some of them want to know utilities. Some of them want to know food. They want to know entertainment, like don't say you spend $3,000 on entertainment. I'm not saying to lie, but I'm just saying like if you just want a lower payment because you want a lower payment, I mean, you're asking somebody to forgive, money off of out of their. You're asking somebody to take money out of their pocket and give it to you.
Got it. Can someone get a loan modification if they're unemployed?
If they have some sort of income, some sort of a way to prove that they're going to make rent, let's just say that they just started renting out the other rooms. If they can prove that they're getting rent from those, there's a possibility for it.
And that was very common, like in the foreclosure dates, because a lot of people were unemployed. And when they were unemployed, they're like, well, how am I going to prove that I have income? I saw a lot of them like starting to rent out their rooms. And basically, like, let's say that you're collecting $4,000 in rents for your rooms and you're trying to get to a $2,000 payment, then that meets that 50% or 45% where you're now collecting $4,000 of rent. What type of documentation do they need if you're renting out the rooms? Like, do they require like a lease agreement? Do they require proof of funds? Do they, or not proof
Yeah,
of funds, proof of
they're gonna
income?
want to see a lease agreement, or they're gonna want to see bank statements. They, I mean, I haven't used it, but a Venmo statement would work because if they're seeing that, that's a way that they're seeing money come in. They just need you need to prove to them that money is coming into your possession.
Got it. Okay, so and then how long do they typically go for that? Like meaning like is this like a month? Like if they just literally lost their job, looking to get a loan modification and they rented out the rooms very quickly, how long does that rental history have to be?
That's going to be up to the discretion of the servicer. But usually, if you write a good cover letter with it, like, hey, I lost my job, but I took action. I'm behind on my mortgage, but I'm going to be able to catch up because I just rented my rooms. Here's the proof of the lease. Here's the proof that they paid me the first month. Then that's going to look more favorable. It's all about painting the story and showing them that you're being proactive and trying to resolve the situation.
Got it. Is there any rules like if you get rejected one time, like can you reapply? And if you reapply, do they take your previous application into consideration, or is it almost like just a fresh start, or is there like a rule of thumb as to how long you should wait to like reapply?
So here's the thing, you know how laws pass and rules pass, and they're meant to do good, and sometimes they're meant, they end up doing some harm. Well, the homeowners bill of rights, they put that so that you would have what they call a single point of contact. So for the life of your loan, you would be talking to, like, if you were the bank, Jose, for the life of my loan, I'd have to talk to you, right? Well, maybe I submitted the wrong paperwork the first time, and you looked at my file, and now I'm submitting different paperwork, and you're like, nah, you know what? Now I just think you're screwing around, and I'm not. So you got to deal with that. So it's going to depend what state you're in and what the rules are and the lender. But for the most part, that's why you really want to make it. You want to do it right the first time, because it's harder to get something approved when you're resubmitting, unless there's some drastic change where the first time you submitted it and you were just renting your rooms and they didn't take that income, or they didn't think it was enough, but now you got a new job, so now you can resubmit and you can show that, hey, now I'm going to be able to get back on track. So if you can show that there's a substantial change that happened between the last time you applied to this time, that would definitely improve your chances of getting approved.
Is there such thing as like a certain limit of times that you can reapply, or is there no limit on that?
Well, there is no limit from that I know, but it's gonna be also working against the foreclosure timeline, right? So if you're, about to get
Behind on the
foreclosed
payment?
on, they're not gonna take it.
Yeah. Now, let's say that you are going through a foreclosure on this. What does that foreclosure timeline look at? Like, what does a notice of default mean? Because I know, like, a lot of times people have questions about like a notice of default. What is a notice of trustee sale date? This is California lingo for those of you guys watching the podcast, by the way. It may
So
differ state to state.
yeah, exactly. And so for California, you have 3 months before the bank can file a notice of default. On that day one of the fourth month, they can file a notice of default. And this is just a notice telling you that, hey, you are breaking the agreement we had in relation to your mortgage, in your mortgage. After that notice of default is filed, you have 90 days to reinstate your mortgage. That means to, figure out an agreement, whether it be a loan modification or forbearance, bring up the, pay the money or sell the property, or find some crazy refi that I don't recommend if you're behind, because they're usually going to be rates that you can't afford and things of that nature. After those 90 days, then they're going to file what's called a notice of trustee sale. That notice has to have a date that's no sooner than 21 days from the date that that notice was filed. So even though they file a notice of trustee sale, they still have to wait 21 days before they could actually auction off your property. Now, these are the general, this is what the law is. This doesn't mean that this is what the bank follows. It'll never be sooner than that, or for them, let's just never say never, but it shouldn't be sooner than that. But most of the time, it'll be longer because the bank takes forever to process it. Maybe they didn't file the notice of default right away, or things of that nature. During the time that's the notice of default and before the notice of trustee sale, they will not take a partial payment unless you have an agreement with them. Because I know I hear that a lot. Well, I tried to send them a little bit of money, or I tried to send them one payment, but you were down 4 payments. They're not going to take it. And the reason is because if they do, they'd have to restart the foreclosure.
Got it. So it's almost like if you're behind on your rent in California, like, and you started the eviction process, if you accept any payment, it kind of cancels out the basically the rental eviction at the same time as well too. So a lot of attorneys will tell you not to take any rental payments if your intention is truly to evict them, basically.
Exactly.
So let me ask you this: like, are loan modifications only for owner users, or do they also do them for investment properties?
I've seen them done for investment properties. Those are obviously harder to get approved, because they'd rather, it's really a mechanism to help homeowners who are living in the houses, but they will do them for investment properties.
Yeah. Let me ask you this. Like, what about extensions? So, like, let's say that, like, this is the first time I'm watching a video and this is the first time I hear about a loan modification and I'm pretty far along in the foreclosure process. Let's say I receive a notice of trustee sale date. What are some tips and tricks for maybe getting extensions on your from your servicer?
So the first thing is, again, call them and let them know what your intent is. Ask them for the application, fill that out immediately, send it in. If you're really up against the gun, try to, like I said, reach out to a broker who may have some connections within the servicer, or go find your nearest HUD counseling agency, because they have special hotlines to the lenders and they get priority with a lot of the things. So that's the biggest hack right there.
Got it. Now, um, obviously we're never recommending for people to get behind on the payments. You never recommend like any sort of bankruptcy. I hear that a bankruptcy stops foreclosures. We're never recommending that. But is that true or not true?
It used to be true back in the day. A lot of the courts have gotten wise to people doing that. Doesn't mean that it won't work, but for the most part, if it does, it's only going to work for a limited. It's not going to work like it did when people first started using it.
Got it. Now, back in the day, like I used to like I just came across this where somebody was behind on their payments like in 2012 and they added a bunch of people onto the title and they basically clouded the title as well too. It's funny because anytime if you get anybody pitching that to you to slow down the foreclosure or anything like that, run. And the reason it's a run is because if you don't know who those people are, you're basically clouding the title to the property. Have you ever heard of anything like that going on?
Yeah, people, there's all kinds of gurus teaching creative financing. And creative financing, there's nothing wrong with it if you know how to do it right. But most people don't know how to do it right and end up just screwing the homeowner. And like you said, if you don't know these people, if you put somebody on title and you need to do anything, you need their signatures to do anything else. And if they're gone and you can't find them, you'll never be able to do anything else unless you file a quiet title action in court. And that can cost you thousands upon thousands. We're talking, like, I guess the last attorney I consulted with the quiet title action was charging 450 an hour.
Yeah, I just got a quote from somebody and they said like anywhere from twenty to $80,000 or somewhere in that range, depending if it's contested or not. Let me ask you this: like at some point when it's approved, they put you on a trial payment plan. Do they still do that? And what does that look like? And what's the purpose of it?
Yeah, so they'll put you on a trial payment plan. Usually it's 90 days, 6 months. Sometimes it could be longer, but the average is 90 days or 6 months. And the purpose is they want to see that you're going to make the payments that you promised you were going to make. Because if you don't make the payments, that violates the terms of your modification, and then they'll just go straight to foreclosing.
Basically. So basically, before they give you final approval on the modification, they'll basically put you through a trial period in some cases. Does that happen all the time or is that not, does it happen rarely?
No, I'd say it happens. It happens more that they'll give you just the modification. It's very rare that they give you the trial period, but if they do, you got to make sure that you're not a moment late with those payments.
Got it. Now, what happens if they come to you with a loan modification, but it's not what you were looking for? So, like, let's say that they come to you with a loan modification and you're looking for $2,000 and it's $5,000. Like, can you reject and reapply?
You can reject it, but you got to have a good reason why you're rejecting it. Like, you got to show them that, hey, no, I can't afford that, and here's what I can afford and why I can't afford it. But if they've already tried, they could also say, hey, we tried giving them a modification, but they wouldn't take it.
Yeah. And then for the payment plan, it's very important. They're basically like trial payments. It's very important for them to make every single payment. Otherwise, it basically leads them back to, hey, look, they failed the payment plan. We're starting the foreclosure again, basically. Is that correct?
That's correct. And with all modifications, like the ones that offer to put money on the back of the loan, like, you got to be careful and read them right, because that money is going to be collecting interest upon interest. So when you go to refi or sell your house, you could owe like a huge balloon payment that you don't even have a clue for. So it's really important that you understand the details of the modification that you're signing, because sometimes, unfortunately, and I know people don't want to hear this, but sometimes it's just more feasible to, if you have equity, to sell, and if you don't, sometimes it's a lost cause.
What are some of the bad like loan modifications that you've seen like in the past? Like something that just didn't make sense for a consumer, like either they're adding the entire principal amount to the back, or what are some of the like just crazy loan modifications?
It's usually one or two. It's that, like you said, where they're adding the principal on the back and there's some crazy interest, or let's just say they're going to reduce the interest to 2% right now, but the other remaining, but it's really a 5%. That other 3% is going to be added, to the back monthly. Like those are the crazy ones. Or that a homeowner, because they just don't want to lose their home, they take that offer that they, like you said, they needed a 2,000, but they got offered 5,000. They take that because they figured, look, this is my only hope, and then they don't make it, and then they lose the property.
Yeah. What is a hardship letter, and what should be included in a hardship letter?
So a hardship letter is you telling them your story, what happened, right? And you've got to have a real hardship. Like you got to remember, you're writing a letter to somebody, and even though these are banks and investors, there's an individual, person, a human that's going to read it and going to decide if you are really going through tough times or you just didn't feel like making your mortgage payments.
Yeah. What happens if you lie on your application? Like, is it under penalty or perjury?
A lot of them are. A lot of them are, because you're pretty much taking out, a new loan in some cases. And that's the other thing you want to double check, is that if is this modification, a new loan, those are terms that, will remove certain rights and things of that nature. That's why, again, you got to be able to read the details of it.
How does the loan modification affect the servicer? Like, I mean, if they made out a loan at 4.5% and they're reducing it to 3.5%, like how does that like who covers the difference, or what happens there?
So the difference sometimes will get write off as a loss on the books, right? But the fact that it's now a performing asset, because most of the time when banks have a non-performing asset, they have to take that certain amount of money. Say it's $100,000 loan, then they got to put $200,000 to $300,000 in their reserves to show that they have enough to cover their non-performing assets. So it really hurts them to have your loan not perform.
Got it. Now, are there tax implications if you receive a loan modification? Like if the servicer is writing it off as a loss, does that mean that there's tax implications by you getting a loan mod?
Yeah, and see that's why the devil's going to be in the details. You have to read if you're going to be issued a 1099-C or whatever, 1098-C, whatever it is, for it, the cancellation of debt. So you have to make sure that's all going to be spelled out in the terms of your modification.
Got it. Any final tips for viewers considering a loan modification or in need of a loan modification?
I would just tell you time is your enemy and your friend. If you're quick at making a solution and going to find one, you're going to have a better outcome. If you want to ignore it because you have like the idea that you're going to be okay, that you'll figure it out later on, the longer you wait, the less options you'll have.
Got it. Okay. And then if somebody wanted to get a hold of you, what's the best way for them to do that? And then is this a service that you guys still offer, or is this something that they're better off reaching out to somebody else for a loan modification?
We still offer. We don't charge anything. The state. Back in the day, we used to, when you were able to charge, but now you are not allowed to charge for loan modification in advance. So there are programs that we have that we still rarely help, because they're not as common anymore. And sometimes I would say that your first bet is talk to your lender. If it seems like you can't work through it or they're not offering you help, then feel free to reach out to myself or reach out to Jose, and he can get a hold of me. But otherwise, you can reach me at my email at info@servefirstrealty.com.
I love it. I love it. So, Guillermo, I wanted to say thank you for taking the time to be on the show. Obviously, this is a topic that I've been wanting to cover for a long time. So, I appreciate it. For our viewers, we hope that this topic was valuable. We had Guillermo Serafin with Serve First Realty. We talked about how to get a loan modification. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that sharp button. Thank you again, Guillermo. And to our viewers, until next time.